Hello all, this is Ryan Baggett here. I'm starting a series on personal finance, and the first entry in this series is on the topic of home buying. It's a topic that I think is important to every person, and something that especially is important to young adults that may be entering into this realm for the first time. So I hope to provide some helpful information on the process, looking at it from an investment perspective, and also, just simply an enjoyment perspective. And I start out looking into it by debunking or addressing some of the common sayings or myths you may hear from other people in society regarding the home buying process. Alright, with that said, let's move into our first slide. So some of the common home buying myths that you'll hear people toss around. The biggest one, number one, buying is always better than renting. A lot of people say when you're renting an apartment, you're, quote, blowing your money away. Or some people use even more colorful terms than that. While it is true that you do not get any of the money back from renting, a large portion of your monthly home payment when you're buying is not returned to you via equity. It's paid as interest to the bank, especially during the early parts of the mortgage, and we'll get to that more in a second. The second myth, or common saying that some people might say, is the maximum amount you can afford for a mortgage is what a lender is willing to loan you. So if a bank is willing to loan you, let's say $300,000, then you set your budget at $300,000, and that's what you buy. If a certain bank's not willing to lend you a certain amount, then some people will try to go to another bank to get them to loan them more. However, banks have their own set of criteria and what they're willing to loan you based on your assets, liabilities, various debt-to-income ratio, etc. Many times you'll find that lenders are willing to loan you an amount that would make you more or less house poor. They may not be aware of certain other obligations or things that you need to do from a budgetary standpoint. So we'll get into that myth a little bit more here in a second. Myth number 3, your taxes will be much lower as a homeowner because of the mortgage interest tax deduction. I've heard a lot of people toss this one around, saying that your taxes will be dramatically lower when you're a homeowner because you can deduct your mortgage interest taxes. While that is true, and you will get a bigger tax refund when you're a homeowner because of the itemized deduction from the interest, it is not necessarily as dramatic of a savings as some people would have you believe, and we'll get into that more in a minute. The fourth myth is that the only thing you need to save for is down payment. In some cases, people even buy without a down payment, which I do not recommend at all. But there are also several costs that need to be accounted for before you purchase your home. Alright, we'll move on to the next slide. So looking more into myth number 1, buying versus renting. Or buying is greater than renting, as I wrote. So while buying a home is almost always financially preferable to renting over a long period of time, such as 10 or more years, it isn't necessarily so in the short term. Mortgage loans are what I call front-loaded with interest, meaning you hardly make a dent in the principal balance in the early years of the loan. Another side factor, if you look at long-term economic data, like over 30 to 50 years or more, looking at the entire United States economy, the rate of appreciation in the housing market is approximately less, somewhere between 0 and 1% higher than the rate of inflation. So for all intents and purposes, from a long-term point of view, on an average standpoint across all different markets in the country, over a long period of time, most homes appreciate relatively at the same level of inflation. Alright, moving on. Alright, here we have a particular mortgage example with specific figures to help illustrate some of the principles that I'm discussing. For the purpose of this example, you are looking to buy a home with a purchase price of $300,000. You are making a 5% down payment, which is generally the minimum amount allowed down by most lenders, unless you qualify for some type of special financing program. 5% down payment on a $300,000 purchase price equates to $15,000, giving you a financed amount or loan balance of $285,000. For the purpose of this example, I'm using a current market interest rate of 4%, which is approximately where we are today, and I'm using a 30-year fixed rate mortgage. So the term of the loan is 30 years, which equates to 360 months, 30 years times 12 months a year. Based on this example, your mortgage payment, based solely on the principal and interest portion of the payment, comes out to $1,360.63 per month. So with the above information, it's not exactly rocket science to calculate that payment. There's several different ways that a normal person could do this. You could use a website such as www.bankrate.com. You could do it in a Microsoft Excel spreadsheet with the PMT function. Or thirdly, you could do it with the use of a financial calculator, which is available for purchase on Amazon for approximately $20. I personally like the Hewlett-Packard HBP2, I believe, is the model. So again, based on the above scenario, your monthly payment will be $1,360.63. But this is only the principal and interest portion of the payment. As we'll see in the next slide, there's more to your final payment than that. Alright, part 2 of the example. So principal and interest are the fixed portions of your payment determined by the mortgage lender, but there are other factors that determine the final amount you pay each month. Property tax is about 1% of home value in the Charlotte area and is included in the escrow portion of your monthly payment. Property tax is something that's levied on you by your county or city, and is usually something that goes for schools or other things important to the local area. It's something that if you do not pay, your home can be taken from you by the government, which I personally do not agree with, but unfortunately it is true. Therefore, it's something that's important that you pay each year. Homeowner's insurance is something you're required to have, similar to the insurance on your car. It's approximately 0.3% of home value, maybe 0.5% depending on coverage. And it's also included in what's called the escrow portion of your monthly payment. If you do not have a 20% down payment when you start your mortgage loan, which the vast majority of people do not have, you will be required by your lender to pay something called PMI, which is private mortgage insurance, until you reach 20% or more equity in your home. In this example, your final monthly payment will be $1,360.63, which is the principal and interest. Property tax, which will be, so the annual property tax is based $3,000 a year, 1% of home value, so 1% times 300,000. Divide that by 12. And your annual homeowner's insurance is about $900, 0.3% of home value. So $3,900 divided by 12 comes out to $325 a month. So that is the monthly escrow portion of your payment. And then private mortgage insurance is around 0.5% of home value a year, $1,500 in this example, which is $125 per month. So when you take $1,360 plus $325 plus $125, your final monthly payment is $1,810.63. The principal and interest portion in this scenario is only 75% of your final payment. Therefore, it is important to understand your final payment before determining how much house you can really afford. All right, building equity, home ownership as an investment. All right, so in these various scenarios, on the left-hand side, we show different scenarios based on owning a home for 12 months, 36 months, 60 months, or 120 months. We show the amount of interest that would be paid on the loan, the amount of principal that would be paid on the loan, and your total amount of money paid via your monthly payments to the lender. The percentage of your payments that is principal, what your ending loan balance would be at the end of that amount of months, and then the percent equity you would have in the home at the end of that time. So as you can see, as I said, with mortgage loans being front-loaded with interest, you start out paying a very small percent of your payment as principal, and it slowly increases over the life of your loan. After owning your home for 1 year, you would only have 6.67% equity, again assuming the down payment of 5%. After 5 years, the percent equity increases to 14.07%, or $42,210. Which seems like a very significant number and is definitely not a bad amount of equity to have. However, it is very important to note that home sellers generally pay both the buyer and seller's real estate commission, which is typically 6% total. With a large home value, 6% can be quite a large amount of money. Moving on to the second part of this slide, based on selling your home for the exact same price it was purchased for, under the various scenarios of 12 months, 36, 60, or 120, we show the dollars to seller at time of the sale, and the sales price needed to break even being defined as being returned at least your original down payment of $15,000. Because when you buy a home, you at least want to recoup the down payment that you pay. Otherwise, it is definitely not a smart move from an investment perspective. So, if owning the home for 12 months and selling for the original price that it was purchased for, $300,000, based on the amount of $300,000 minus your ending balance of $279,981. And then taking away the 6% realty commissions that you would most likely have to pay, you would only receive back $2,019 at the time of closing, which is $13,000 less than your down payment of $15,000. To break even, meaning get back at least the $15,000 down payment at time of sale, you would need to sell your home for $313,850 after owning for 1 year. If owning for 3 years, that number drops to $302,500. In the 5 or 10 year scenario, you could sell your home at a loss, less than $300,000, and still receive at least the $15,000 down payment at time of sale. Now, of course, it's very common, especially in the Charlotte area right now, to sell your home for more than you paid. However, the purpose of this illustration is just to show that if owning your home for a very short time, there are by no means any guarantees that you will be able to make a profit at the time of sale. To make a profit at time of sale, you generally need to sell your home for more than you paid and also have a decent percentage equity in the home. So, reviewing some of the conclusions that I draw from myth number 1 when people say that buying is always better than renting, period, and they don't explain themselves. I would say that home ownership is financially advantageous to renting over a long period of time, but not necessarily so in the short term. Buying a home is definitely not a get-rich-quick scheme. And also, your monthly payment can increase significantly based on property tax, homeowner's insurance, and PMI. I should have gone over this slide a bit earlier in the presentation. However, here are some of the Here are some of the mortgage terms defined that I've been using throughout this presentation and will use for the rest of the presentation. Principal is the amount of each month's mortgage payment that is applied to your loan balance. So this is the amount of money in each payment that builds equity in your home that you can have returned back to you at the time of selling your home. The other main portion of your payment is interest. This is the amount of money you pay to the lender each month as a service fee for lending you the money. You can then list your mortgage interest as an itemized deduction on your yearly tax return. PMI stands for Private Mortgage Insurance. This is something that lenders are required to carry to cover the risk of a buyer defaulting on the loan, i.e. being foreclosed on. Lenders require borrowers to pay PMI if their down payment is less than 20%. Once a homeowner's equity is 20% or greater, they can call the lender and request their PMI be canceled. Unlike principal and interest, there is no intrinsic value to PMI. It does not reduce your loan balance and it cannot be deducted on your yearly tax return. So basically, obviously principal, that part of your payment is very valuable because that's money theoretically that you'll get back as long as you sell your home for what you paid for it or higher. Interest, is the majority goes to the bank, but you do receive a small portion of that back as a deduction from your taxes during your yearly tax return. So there's definitely value to both of those parts of your payment. However, PMI cannot be deducted and it does not affect principal. So definitely trying to eliminate PMI as much as possible is a good strategy. Other mortgage terms: property tax. It's a yearly tax exercised against your home by your local government, which is included in the escrow portion of your payment. I believe I already touched on that. Homeowners insurance, again, similar to car insurance. This is liability insurance in case something happens to your house. Will cover major repairs like wind damage, fire. Most policies do not cover flooding or water damage. If your house is determined to be in a flood zone, you must purchase flood insurance separately, which can be extremely expensive. So definitely know before you buy whether your home's in a flood zone, and if it is, you may want to not consider purchasing that home. Anyways, so escrow is the monthly portion of your payment that covers property tax and homeowners insurance. The bank collects this money from you each month as part of your monthly payment and then stores this money in an account for you. When they receive the yearly bill for property tax and homeowners insurance, the bank will use the funds in your escrow account to pay these expenses. As a homeowner, you will receive a copy of these bills, the property tax and insurance, so that you can note the amount and see if it differed from the prior year. However, it is very important that as a homeowner, you never pay those bills yourself. That money is already stored in your escrow account, and it is your lender's responsibility to make those payments for you. Myth number 2. How much can I afford? Lenders use a debt-to-income ratio to determine how much they are willing to lend you. However, lenders generally will loan you more than is financially prudent for you to spend. I recommend preparing a monthly budget of all expenses before starting the home buying process. Decide on a monthly payment that you can afford based on your budget, then determine the max loan amount from there. Do not rely only on the lender to determine affordability. It is very important that you do not want to become house poor, which some lenders will allow you to do. Myth number 3, mortgage and taxes. Mortgage interest, as stated before, can be written off as a tax deduction, note the bold and the underline, and not a tax credit. There is a difference. The first-time homebuyer credit, the $8,000 credit Obama instituted a few years ago, was a hard credit. So anybody that got that had a straight additional $8,000 that they received in their yearly tax return. Deduction is something that's applied to your tax rate and used to reduce the taxes paid. If, for an example, you paid $4,000 in interest for the year and your tax rate was 20%, the amount of the tax deduction would be $800. thereby increasing your yearly tax refund by around $800. However, that other 80% is money that you don't get back. So out of the $4,000, you still have a net loss of $3,200 that you pay to your lender in interest payments. While interest is certainly important for tax purposes, the amount of savings between buying and renting is generally not dramatic. When some people cite the difference in taxes between buying and renting, it can be overblown. It is certainly something to take advantage of if you are a homeowner, but using it as a justification to buy is not the most financially prudent decision. Myth number 4, savings and down payments. Buyers need to save for a down payment, closing costs, furniture, and other miscellaneous expenses. What are closing costs? Closing costs are an additional expense generally paid by the buyer that includes such things as title insurance, attorney fees, land survey, and mortgage application fees. Closing costs are approximately 2% of the home's purchase price. Note that closing costs can be paid by the seller and is typically one of the most common negotiating points between buyer and seller when going under contract. So while buyers generally pay it, it is not uncommon for the seller to pay it if the buyer agrees to the price that they want. Here we have another financial example with real hard numbers tied in to the down payment aspect. So again, using a purchase price of $300,000, a 5% down payment of $15,000, then tacking on the closing cost of 2%, which is $6,000, accounting for $2,000 of furniture or miscellaneous expense. That number was pretty much input randomly. It could certainly go higher or possibly lower. If you are just moving from an existing home to a new home and already have furniture, that number could be lower. But we'd also include stuff in that category like moving expenses, if you hire movers, rent a truck, whatever, anything like that. So the sum of those expenses in that category comes out to $23,000. Something else important to take into consideration is an emergency fund in your savings account. Most financial advisors recommend that you keep an emergency fund equal to 3 to 6 months of expenses at any given time. For the purpose of this example, I'm calculating this figure based only on your mortgage payment. But of course your actual monthly expenses will be higher, including things such as food, gas, utilities, etc. So the purpose of this example is more of a conservative estimate. But based on maintaining a 3-month emergency fund, you would multiply 3 by your monthly payment of $1,810, giving you an emergency fund of $5431.90, or a 6-month emergency fund of $10,863.80. When factoring in the $23,000 of expenses in either the low or high scenario of an emergency fund, you would need to save somewhere between $28,431 and $33,863 to be able to buy a home in this price range. Of course, some people may feel they can do this without maintaining the emergency fund, but you are putting yourself in a lot of risk. If someone were to lose a job and you are unable to make your mortgage payments, most lenders do not give that much of a grace period before they will foreclose on you. If you get foreclosed on, you lose all the equity you have in the home, which would include your down payment and any equity gained since the loan started. Final thoughts. Homeownership can be a great upgrade to your quality of life, especially for family purposes. But it's important to understand the full financial impact of the decision before entering into it. As said before, buying a home is typically a great financial decision if owning long-term, but is not necessarily so in the short term. While it is possible to make large profits in the short term in certain instances, it is by no means the norm. Your first step should be creating a monthly budget to determine affordability. Then only review houses within your price range. The worst thing you can do is look at houses that you can't afford because it distorts your priorities and tempts you to put yourself in financial danger. I hope this information has found you helpful. I look forward to sharing more financial thoughts with you in the future. Bag it out.